The so-called currency wars have become a hot topic as we head towards a G20 meeting this week in Moscow. And tensions have been rising recently on whether some countries are deliberately trying to weaken their currencies to make their exports cheaper in the global market. Stephen Englander, Managing Director and Head of the Group of 20 Currency Strategy at Citi Group, joins us now with more on what we should expect in this week's G20 meeting. Stephen, thanks for joining us.
It's my pleasure, Michelle.
Stephen, the International Institute of Finance today put out a strong statement saying that the G20, the group of 20 richest nations, needs to act to avoid a currency war. What kind of action do you think we'll see out of this meeting?
I think that they'll put out a statement that will be very generic, that will encourage countries to avoid taking measures that actively depreciate their currencies. The problem with the G20 statement is that half the G20 can be accused of depreciating their own currencies. So pointing a finger at Japan implicitly means pointing a finger at themselves.
Now, explain to those of us who don't really understand what it means to have a currency devaluation and how that is favorable for an economy.
Sometimes it's hard to explain, but the logic is one that it makes you more competitive in international markets, that you can sell your products more cheaply than your competing countries. If you're an automaker, the fact that your currency is cheaper means you can price it lower in a foreign currency. The other part, which I think is often neglected but is very important, is that there are translation benefits, that your exporters, when they convert their receipts into the local currency, their profits are higher, and that tends to support the equity market and make people feel richer.
Now, the Eurozone has seen a 6% increase in the euro over the last 6 months against a currency, against a basket of other currencies. This indicates that there is strength in the Eurozone, but the Eurozone countries aren't happy about it, particularly the French.
Well, will you forgive me for disagreeing? It indicates that people want to buy the euro. Many people were short the euro. And I think the euro strength...
So renewed confidence in the Eurozone, perhaps?
I think that's correct. I think what it suggests is that the terrible pessimism that existed with respect to the euro's future has abated. Many investors were short euros, were either underweight or had actually sold euros, and they have to buy it back.
So one of the other big issues here is what we're seeing with regards to Japan. A lot of controversy, a lot of criticism leveled at Japan for manipulating the yen. Can the G20 do anything to address this?
Well, I think they will come out with a generic statement, but if you look at what finance ministers and central bankers and the G7 say, there's a lot of leeway for making comments that implicitly say, sell my currency, and still remain within the G20 bounds. So I think Japan will change its rhetoric a little bit. It won't change its policies at all, and the yen will continue to decline.
Now, there's always been talk about the renminbi being a subject of government control. What do you think about that?
Well, it is, and it has been. I mean, it doesn't trade very actively. It trades very actively, but it trades within very narrow bands, and obviously has been under, control by the government. And I think there's less pressure on the renminbi now because the inflation in China over the last few years and the tendency for the renminbi to appreciate means that in real terms, they've actually been appreciating, that even though it hasn't been a free market, it's been headed in the right direction from the point of view of other countries. And you hear about complaints, of cost pressures and that China being outcompeted by other countries, which suggests that China is becoming more expensive. It's still an issue, but I think it's less of an issue now than, say, was the case 3 or 4 years ago.
And do you think part of that is because China may be eyeing towards being a global reserve currency, having the yuan as a global reserve currency?
Maybe, but I actually don't think so, because being a reserve currency carries certain obligations, responsibilities, convertibility, and I'm not sure that given the control that they've tried to maintain over their currency, that they really want to go that distance and become a reserve currency. More actively traded, yes, but reserve currency, I'm not so sure.
Well, Venezuela has taken some big steps today, saying they're going to reduce the value of their currency by 32%. What's your thoughts on that?
Well, I think in the black market it was already trading quite low, and they're just accepting a reality that the inflation that they've had has made the Venezuelan currency, not worth what they were trying to peg it at. It's the fate of countries that sort of intervene in markets and create inflationary circumstances.
Now, with regards to the Japanese yen and the European countries, who is likely to be the beneficiary of the currency wars, if you will?
Well, I would argue that the G4 or G5, if you include Switzerland, have the advantage because many emerging countries, if they matched the G5 in terms of expanding balance sheets, throwing liquidity into the world, they would face inflationary pressures more quickly. They would face asset market pressures, rising home prices more quickly. And those are big social issues in the EM, whereas they're not social issues in the G4. So I think that the G4, G5, if you include Switzerland, can live with the consequences of this expansion of liquidity in a way that emerging markets and some of the smaller G10 currencies can't.
Okay, well, we'll see what happens at the G20 meeting. Thanks to Stephen Englander, Managing Director and Head of Group 10 Currency Strategy at Citi Group.